The Lal Street ends higher for the second week in a row. The Nifty and the Sensex rise 1% this week. Mid-caps outperform. This week, we take stock of the big block deals seen on the Lal Street. We put the spotlight on India's jewellery sector and we'll decode the market action. Hello and welcome to another edition of Editors Roundtable. I'm Reema Tendulkar. With me, we've got Nimesh, Mangalam and we've got Mihir Vora with us in the newsroom. Hi, boys.
Hello.
Hello. How do you feel this Friday afternoon?
You feel tired after running on a treadmill. That's exactly how you feel. Why is that? Because yes, you've run, but you haven't gotten anywhere.
Yeah.
So that's exactly what happened in the markets as well. So much happened, and yet we're up by just 1% for the entire week. A lot of stocks moved. A lot of stocks moved in either direction. A lot of buyers, a lot of sellers. So much happened, and still we are here on a Friday.
But not a bad outcome, honestly. Given the fact that we've rallied pretty hard, we've been outperforming. This week saw some bit of jitters from the global markets as well, at least towards the end of the week. But still, we managed to hold on. The fact is, even if you look at our internal data, the PCR is at almost 1.4, which is not a healthy sign. 14, 15 stocks are in F&O ban, and large blocks were 20,000 crores, and still we are up 1%. So I would read it that way, that the momentum still seems to be with the bulls. Despite so much of supply coming in, we are marching ahead. And the fact is that we are ignoring a lot of global as well as local news. So I guess a bit of complacency now in the market. One needs to be watchful. But the moment, it's basically a liquidity market, so you can't complain.
So even after absorbing this kind of supply, the Nifty is up 1% this week. The mid-cap index is up 1.5%, and the small-cap index has a gain of close to about 3%. Mihir, you're also surprised, right? We've seen flows of 5,000 crore of cash in a single day. That happened on Thursday. Both the FIs and DIs purchased, but the markets have not moved up.
Absolutely, which also shows that there is supply coming in at higher levels, and it's no surprise. We have a host of IPOs. We have QIVs almost every day of a couple of companies. You have PE funds selling. You have promoter blocks being offered for sale. So I think at a price, supply does tend to respond to demand,
And this week it's accelerated a bit. But I just want to put on board the HSBC note, Nimesh, that you were highlighting earlier. And they say that Indian equities are hot, undoubtedly. But after 13 out of the 15 years of gains and trading at lofty valuations, they're asking the question, what can go wrong? So they've identified 10 risks which on their own do not pose any kind of an immediate threat, but in aggregate, it could derail the rally. So they continue to stay overweight on the Indian equity markets. They're acknowledging the risks in the Indian market and the 10 risks that they've highlighted. 1, the stress for banks is increasing. 2, banks are struggling to grow deposits. Private sector capex is sluggish. There is weak and concentrated foreign investment. Unequal consumer growth. There are risks to earnings. Q1 earnings has been very, very muted. ESG and sudden changes in the regulations. Mihir, put all this together. Do you think a correction is coming? What's your own gut?
Price correction, I'm not too sure, because I think nobody wants to call the top because of liquidity. The kind of mutual fund and insurance and NPS, etc. flows that are coming in, that financialization theme continues to grow. But yes, I would be worried on a couple of fronts. One is that we've just finished the earnings season now, more or less everything is out in terms of results. And if you look at the top 100, 200 companies aggregate, the numbers are not that great. You've seen single-digit earnings growth in the Nifty. Now you can slice and dice by saying metals, non-metals and all that, but the headline number is a single-digit growth and almost 1% growth only on the Nifty earnings. And this is after probably after 3 or 4 years that we've seen such a low YOY year-on-year growth on the Nifty earnings. So that's one. Second is the US is slowing down. Now, of course, the flip is that because the US is going to slow down, we are going to see rate cuts, so you can be happy about it. But the fact is that the US is slowing down, and the largest economy in the world is not doing that great. China anyway has not been, it's been struggling for a while now. So we do have global headwinds coming in, and with the large cap earnings at least not looking that great, it's time to be a little more choosy, if not cautious.
So how are you choosing your stocks in the portfolio? Because you've just recently launched a multi-cap fund as well. I spoke to a lot of investors, including you, at the couple of conferences, and everybody seems to be a bit cautioned, right? And normally, market doesn't favor the consensus. So in that sense, how are you looking to position your portfolio?
So I read a WhatsApp forward somewhere, that fund managers are worried, advisors are cautious, but retail investors are optimistic. So that's what it looks like currently. So it's only been 4 months since we launched our fund, so not great in terms of churn, but actually in the initial portfolio we used to probably have a lot more industrials. Just 4 months ago we were very overweight on industrials and the growth names like defense, all those themes. But fortunately they ran up very sharply. Probably aided by some of the large NFOs in the manufacturing space, defense. So stocks rallied, and actually we started trimming also. So 4 months is really a short time to really trim your position, but the gains were so high that we actually trimmed positions in the industrial space and going more into some of the capital market links themes, the pharma plays, etc.
So Mir, is this going to be the trick now that as fund managers you have to be very aggressive, buying also and selling also, and like churning the portfolio every now and then is going to be the key mantra to have an alpha?
See, active, I wouldn't call it churn, I would call it active management.
Right, sure.
And for us, the churn or the buying or selling decisions come because of either price movements or change in fundamentals, right? If everything else remains same, there's been no earnings upgrade and the stock is up by 50%, then probably you want to sell it, right?
So, on these fundamental related versus price movement itself, there are so many confounding cues. When you started out, you said that US is slowing down, but now the belief is that maybe, because US is slowing down, the Fed will cut rates and that will be positive for us because that will infuse more liquidity. Similar is the case for promoters selling as well, right? One looks at promoters selling as a sign that the promoters are exiting, but a lot of them look at it as increase in free float and thereby perhaps an increase in MSCI weightage, and therefore there would be some more funds coming in. So it's that market where everything is justified to one's original benefit. How does one then maintain their rationality in a situation like that?
Absolutely. So you ultimately you got to stick to the knitting, which is study the valuations, study the growth prospects, take a bigger picture view and act. So as I said, I typically would not like to churn a stock in 4 months, but if a stock is up 60% and nothing has changed, then probably you want to trim it, right? So that's how we work.
Okay, hold that thought because we want to get your thought in also on the jewelry space. Mangalam, you've done some analysis, and this week we had big moves in Kalyan Jewellers.
Exactly. We were talking about the promoter stake selling, etc. This was the first time when a PE, sold and the promoter bought in a very long time, and that explained why the stock moved higher. So I thought, let's use that as a peg to try and understand what's happening in the jewelry sector itself. So the jewelry sector in India, of course, is comprising of a lot of the others and the leader itself. The leader is Titan. We are talking about that, and we're talking about how the others have panned. So if you look at, Titan's stock price move over the last 6 months, it's actually negative versus Kalyan Jewellers at 57%, Senco at 36% as well. Last 1 year, Titan's up 17%, Kalyan Jewellers up, along with Senco, up nearly 160 to 170% as well. And you expand the time horizon, 2 years, Titan's up 48%, Kalyan Jewellers is up 650%, and from its issue price, Senco Gold is up 250%. So it's over 2 years of underperformance from the leader. What exactly is happening? Well, if you look at the thesis of the industry, not much has changed because the organized sector is still growing at 2 to 2.5 times industry, but it's the disruptors, the newer players who are growing faster due to one, lower base and getting access to a lot more capital by listing or raising funds, etc. There's store expansion through franchises and obviously the margins improving due to operating leverage as well. The product differentiation in jewelry between two brands has reduced because of BIS, competitive intensity, price parity. Everyone's margins have compressed, and there was a huge valuation gap between Titan and the others. That has become narrow as well. So if you look at Titan's jewelry margins itself, over the last many quarters, it's come down from 14.4% to about 10%, talking about the intensity in competition in the market. And this when the revenue growth has been similar to all the other players on the huge base as well. If you look at all the other players as well, where do they stand? Titan, for the last year, trailing 12 months, revenues were close to around 44,000 crores, Kalyan closer to 20,000 crores, Senco and Thangamayil between 4 and 5,000 crores. But in margins, Titan is the clear leader at 11%, and which is why it gets the maximum market cap as well at 3,20,000 crores. And with the up move that we've seen, everyone else is at 61,000 crores and below. Titan has 490 stores, Kalyan 277, Senco and Thangamayil between 59 and 165. Kalyan has actually increased its stores by a fair amount as well. So what next will happen for the jewelry sector? There is improved consumer sentiment ahead of the festive season, the cut in the budget, store expansion in India and abroad would be the key trigger for every player. Design and brand positioning will be the key differentiators for Titan and the others. We need to watch out for the impact of lab-grown diamonds and how that plays out on margins. And then there are newer formats like Carrot Lane for Titan, Candere for Kalyan, etc. Kalyan is looking to divest its non-core assets. Titan is looking to grow through new categories, balance sheet improvement for players like PC Jewellers who have doubled in this year itself, and leadership transition for Titan sometime in the next year as well. Everything has a price. So let's look at it. 2 years ago, Titan was trading at 64 times, Kalyan 19 times, and Senco 13 times. 2 years later, after the underperformance, Titan is at 60 times, Kalyan is at 50 times, Senco at 29 times. So I guess what I'm saying is that the valuation differential has narrowed quite a bit. With this underperformance, is it time now for the street to remember the Titan?
Okay, interesting data that you've compiled there over Mangalam. Mihir, are you bullish on the jewelry stocks? Gold prices have inched up. Then there is that budget push with the customs duty cut. Consumers are lapping up. There is so much money to spend, right? It's going in real estate, it's going in stocks, and it's also going in jewelry. But he's put up a comparison
the
of
most interesting data from Mangalam's piece was that Titan's valuations is at 60 times now, whereas the others have caught up very sharply in the last 2 years. Now Kalyan is quoting at 60 times, and Senco is around 40 odd times. So, what would you prefer in the jewelry space in case you have to buy something in that space? Will you stick with the leader?
So, a couple of things from the data that Mangalam presented. One is that it is a growth sector, right? So everybody is growing. It's not like one is growing at the expense of others. There is, as you rightly said, there is enough. The market is big enough and growing at a reasonable. It's a recession-proof industry. That's why it's always traded at a very high premium, because there's a lot of visibility of the top line. But now I think the industry has come to a certain size that there is space for more people, right? So the shift basically is not from one organized person to the another.
It's from unorganized.
It's from the unorganized to organized, and I think that will continue. Sure. So there is space for a lot of large players. That is one, and second is there is a difference in business models that the different companies are following. So there is a differentiation in terms of business model. While everybody is doing jewelry, everybody is doing studded versus gold, etc. There are certain differences in the way some companies are handling their franchises, some companies are owning their own shop. So I think that's also reflecting some of the valuations. If you as you rightly pointed, the market is rewarding higher growth. So the narrowing of the premiums is because of the differential in growth rate, I would say.
So do you have any jewelry stocks in your
Yes,
portfolio?
we do. I'm positive on the sector.
Oh, you're positive.
Sorry. Go ahead, Nima.
Yeah.
And what about on the other consumer sectors? Are you bullish on any part of the consumer discretionary or consumer staples segment?
So we have selected names. We actually have very few of the large cap FMCG stocks, frankly.
Okay.
Whatever we have in FMCG are very niche companies, which are...
What is niche?
Niche in the sense, for example, some snacking company, that company, some of the companies which supply to, say, kids, etc. So which are in segments which still have a long runway of growth, which is in line with our philosophy, that it should be a fast-growing sector or a fast-growing company with a long runway of growth.
Speaking of fast-growing companies, I just wanted your thoughts on Zomato and all the other platform companies. I mean, it's moved nearly 5 or 6 times from its recent lows itself, and now it's acquiring newer companies, it's acquiring newer platforms. District itself could be a next 22,000 crore opportunity for them in terms of valuation addition. What are your thoughts on Zomato?
So we've always been positive on platform companies, and as we during the NF also, this was one of the themes that we are pursuing, apart from the consumption and the financialization theme, infra theme, etc. Essentially, these are segments which are going to become oligopolies.
Okay.
It is a winner-take-all kind of a situation. So you'll have 2 or 3 or 4 players in each segment, and the total addressable market is anyway large. Plus, companies are going into adjacencies, so they can expand the TAM, by going into a newer category, which is what we are seeing in a lot of these cases. So we structurally remain positive.
Mir, a word on the luxury brand plays. Are you looking at that sector in a very strong way? Look at Ethos for example this week. At a record high, promoters sold out, and still, the funds are looking to buy into stocks like Ethos. In that luxury brand play, anything that strikes you, which is still quoting at reasonable valuations?
So while we don't own any of those of this, but structurally the K-shape is still there. Right. So you are seeing much more resilient demand at the higher ends of all the consumption items, frankly. So I don't think that's a surprise.
So if again, just taking a name here, Stanley Lifestyles is the other one, which looks at a large total addressable market, which is the luxury furniture market. Again, the same thing that one would have looked at in the jewelry sector, say 20 years ago, where a large part is unorganized. There is one large organized player. Do you think there is a case for this shift here and underlying wealth creation? Not specifically the stock, but the sector?
Yeah. Only thing is, you also need to consider the particular segment, what the competition levels are. So some of the segments are prone to national monopolies or oligopolies. Some of the segments are anyway so fragmented that it may not be possible to make abnormal margins for a long period of time. So you need to analyze using that prism also.
Mihir, do stay on. We want to slip into a very short break, but we'll come back and talk about the mega block deal scene in this week. Stay tuned.